Welcome back to Good Returns. I'm Matt here with Garrett. Third consecutive week of market gains, new all-time highs, and a week where the data told a very clear story. Jobs softened, inflation stayed contained, and the September rate hike that was looking increasingly likely by people that bet on such things a few weeks ago is now looking...
The market.
Increasingly unlikely. That's it. That's all I got for you.
Yeah. Planning room topic today going to be fun. Small businesses. Small business confidence just hit the highest level in nearly a year, and we wanted to do a little bit more than just mention it as a passing data point. So we're going to dig into actually what that means, why it matters, and we're going to get to kind of celebrate small businesses and what they are in this economy. And, we know what it feels like because we are a small business. So we're going to excited to put some context to that conversation. It's going to be fun.
Yeah, before we get in, a quick note. As always, everything on Good Returns is for educational purposes only. Nothing we say is personalized advice. You should always reach out to a trusted advisor. And if you don't have one, you can go to momentumwealth.us, and we would be more than happy to offer you a free consultation and speak with you about your specific situation. So keep in mind, we're here to give you context and help you to think more clearly.
Let's talk about the week. Tell us what happened.
S&P up 1.2, hitting a new all-time high. Of course, when you're at all-time highs, any move upward is considered a new all-time high. Keep this in mind, ladies and gentlemen. The NASDAQ was up a little bit more at 2.4%. The Russell 2000 up 1.8, also setting a record. Technology did lead that movement at 3%, and then energy was actually up as a sector last week, of course, on the back of the whipsaw of oil.
Once again,
yeah,
favorite topic here.
Yeah, but Russell 2000 being up is really the most interesting aspect of that to me.
Well, it goes into our small business conversation that we'll have a little bit later. But if you look at the equal weight also, S&P, equal weight S&P gained 1.9%, essentially matching that cap-weighted index. So that is kind of commentary to the breadth story.
And beat it.
It was kind of encouraging. Yeah, I mean... growth led, we had value participate too. We've had that kind of conversation the past few weeks. International stocks kind of in line with U.S. stocks, which is sort of a shift because they have been lagging in past weeks. That's a healthy kind of broad advance. Doesn't really scream a narrow one, but it's broadening out, which is what we like to see.
Yeah, we had bonds advance as rate hike expectations fell sharply through the week. Your shorter maturity bonds outperformed longer ones, meaning that the rates on the short end of the curve fell more than the ones at the longer end of the curve. So that's a pattern you'd expect when the market is repricing the Fed's next move to be lower. Gold continued, I guess you could call it, drifting higher. Really nothing too exciting there. The volatility index fell below 15, sitting near its lowest level of the year. So that fear gauge is telling you the market is increasingly less worried. I would never say the market's not worried, but it's increasingly less worried.
Yeah, I mean, we have, you mentioned gold. We bring that up. Past 30 days, we're up 8% for, I'm just looking at an ETF right here, but puts our year to date at just shy of 2%. So we've had some serious moves in gold in the last 30 days. Is that enough to kind of move some people off the couch, so to speak, and go back into the gold sector that had come out of it? I don't think so, but it's certainly encouraging and it's certainly heading in the right direction. So we'll see what that means at whatever time in the future, that data becomes more clear. But another interesting part of the kind of story is first week, we had Berkshire Hathaway, Warren Buffett. We had them net buyers of stocks. So the first time in a few years, maybe, that they have come off their stockpile of cash and started to buy stocks. So that's sort of an interesting anecdotal sort of data point, I guess you could say. What does that mean? What are they seeing? Obviously, they're seeing something they like to get off the cash. So keep kind of monitoring that. But that's a lot of people like to talk about his buys and sells and when he's super defensive and he's on the sidelines. So, it warrants discussion when he also comes off the sidelines a little bit.
Yeah, I think so. I mean, if anything, it really underscores that we went through from really the COVID era until you could say last year, maybe this year, where cash was an okay place to park new value, new dollars. You got to think of Berkshire's portfolio, the dividends, and the any proceeds from the sale of any other stock or sale of businesses that may not have been publicly traded, or the dividends that were coming in and deciding not to be reinvested as that cash builds up. It was not, in a relative sense, historically, it was not the worst place to put cash relative to historical returns on cash. Now, it was the worst place to put it when you compare it to the market, right? But when you compare it to, over a 20-year period, maybe only getting 1.5 or 2%, they were able to get 5 or 6. So in a relative sense, it kind of made sense. I think it's marking the end of that era, the acknowledgement that the debasement trade is not going anywhere. It still exists, and it's going to accelerate, especially as rates continue to fall. They're deploying that cash because, again, whether it be the everything code that others talk about, whether it be people like Lynn Alden discussing the debasement trade, there'll be variations of the acceleration or deceleration of debasement, but it's not going anywhere. And the more dollars that Berkshire holds on to, the less value they are creating for their shareholders over a long period of time because of the devaluation of the currency.
Yeah.
The debasement of the currency.
It's a definite risk. It's interesting to see how they manage that risk, though. But we can kind of pivot that into, you made the point about the shifting rates. So we had some information this week that came out with CPI and PPI and all that kind of stuff that would kind of change that conversation a little bit from even last week when we talked about the market itself pricing in, with over a 50% certainty, I guess, as certain as you can be, but 50% chance of a rate hike in September. That's pretty much, not the case anymore, which we talked about. Let's walk through what happened with that, though.
Yeah, so you had people pricing in, like you said, greater than a 50% chance of a rate hike. That is now drastically reduced because you had the employment report coming in where, it kind of surprised that 23,000 jobs were being cut in July, and I think they were looking for growth. It was a negative number, job losses, not gains. Prior months were revised down by a combined 100,000. This is a story that's as 3 and 4 years old at this point, where the government data, upward or downward, is always being revised for the jobs. It's getting to be very unreliable. But those revisions were pretty significant because they'll tell you that the hiring is weaker than the original data suggested, making it appear the labor market has been softening. Now, I know there are some out there that would argue against that point, and they have a valid perspective. But when you're seeing that occur, and the CPI headline coming in under, you're building the case for cuts, not hikes.
Yeah. You had headline consumer prices on Wednesday. They rose 0.1% in July. PPI was essentially flat, which was actually below expectations. And then energy is still running at 14.5% higher than a year ago. But the key that we're seeing here, and the kind of storyline that's playing out in the data, is that the energy increase hasn't really spread into the broader inflation measures, and the feared sort of pass through from oil prices and everything else in the economy hasn't really materialized like some people expected it to do. And so that's encouraging because it gives the Federal Reserve the data points that it needs to, I don't even necessarily think cut. We've talked about that for a while, but I think just to maintain the status quo, which is what I would expect throughout the rest of the year. And then maybe next year we start talking about cuts.
Yeah, I don't think that's out of the ordinary of a pattern of a normal operating Fed. You go back to the 90s and you look at, the rates were going down, but it wasn't like instantaneous crisis level, right? It was slow, methodical adjustment to more of a normal policy rate. I think that's reasonable. But we've seen, time and again where, oil driving the headline of the inflation numbers. And then time and time again, we're seeing the inflation data not responding the way that people say it's going to respond. And this is why we caution you can't let the headline impressions guide you in financial planning or in retirement planning, because, if you'd have bought the story that oil was going to go to $200 or $300 a barrel, or that oil was going to push inflation up and they're going to hike rates, there's so much behind what it means when oil goes up, that it's not always a straight line to the Fed increasing interest rates. The logic would be like this. The price of oil goes up, ergo your mortgage has to be more expensive. In what universe does your mortgage being more expensive solve the problem of prices going up because of oil? It does absolutely nothing. We spoke about this in the office this week. And I want to bring it back up because we're seeing this play out in real time. What you're seeing and what you're listening to is a couple of guys that run a wealth management firm and have for a long time. Thousands upon thousands of interactions with clients putting their interest first. Not only is that occurring, but we're also astute observers of the market and of micro and macroeconomic trends, things that interest us as well that we'll watch. When you have the price of oil go up, what that means is that the people who are most impacted by that price increase have less money to spend on everything else that they need in their life. And when they have less money to spend on everything else that they need in their life, those goods and items are not being purchased. The only way for those goods and items to be cleared by those businesses is for those prices to come down or for those businesses to face financially troubling times. Okay, that necessarily creates deflation. It must. If the spending public has no money to buy goods or services because oil is so expensive, then the businesses selling those goods and services will have to lower prices or they will have to go out of business. If they go out of business, they go bankrupt. If they go bankrupt, they don't pay their debts. If they don't pay their debts, that destroys currency, right? It's gone. So you have deflation. There's no way around it. You cannot have systematic inflation because the price of a commodity goes up. Inflation comes from one place and one place alone, and that is the central government. The central government creates new currency. That new currency, that debasement creates inflation. That's it. The price of eggs going up does not create inflation. The price of gold or oil going up does not create inflation. It just simply doesn't. No more so than the price of SpaceX stock going up creates inflation, right? When your 401k goes up, did that create inflation? Well, that's a price of something going up. You should be happy about it, right? But we see the price of oil go up and everybody thinks, oh my God, inflation. But the price of your Coca-Cola stock or your Aflac stock or your IBM stock going up, that doesn't create inflation. No, that creates good feelings for you, right?
Well, I think it's because of the transportation cost of businesses that would have to transport things that they buy. And so, a lot of that is moved on the road, and oil prices do affect those things. And so I think that's what people maybe were expecting to see, is those sort of price increases from that more expensive transportation of those goods and services to kind of trickle down through it. But, to your point, if you can't buy it, you can't buy it.
Yes, and if the business, it costs me more to transport the goods, but you have to solve a problem, because the DHL, FedEx, UPS, Old Dominion, they don't have a money printer that they can just be like, oh, well, it cost us more to ship.
Yeah.
So now, no, you have to cut something. You have to get more fuel efficient trucks. You have to package your products differently. You're going to make the package itself lighter weight. You're going to change your routes. You're going to figure out a way to keep those prices where people can still purchase the items, because if they can't purchase the items, you're out of business. And if you know anything about the Great Depression, when you have the collapse of the velocity of money, it doesn't matter how much debasement or how much printing the government does. When the rotation of that money collapses, you have deflation, not inflation. It's very interesting. I mean, I'm not saying there's a straight line here, but what I am saying is that when you're looking at retirement planning and when you're looking at how to construct your portfolio, you should put zero weight or consideration whatsoever on the price of a commodity. Whatsoever, period, full stop. When it comes to oil, the fact of oil going up should not make you decide that you should not retire this year. Or the fact that oil's going up should not make you decide.
Well, I think that's dependent upon what you're invested in. But yeah, to your point.
That's true. That's true. Yeah.
If your advisor is, trying to convince you to move into oil because it's going to pop, or, it's not going to pop, or whatever it is, that kind of, we would urge diversification in those instances instead of like sector related or commodity related investment like tranches. But we it's not something we don't do. I mean, we do have commodity and related to gold or any of those types of things, we occasionally will have a position there, but it's very measured, and it doesn't generally, it's measured and it's diversified. So
and you can also get caught off guard too, because you can think that inflation, you can rightfully know that 10 years from now, the $1 million that you have today will only be worth $800,000. And that can be a real fact. But throughout that 10-year period, investing as if inflation is the greatest threat to your portfolio can also be the wrong strategy, because it can allow you to overweight to sectors or overweight to parts of the market that's not going to give you the most growth and the most value accretion, because you can have multiple things be true at one time. You can have the simple fact that we know there will be debasement of the currency. There must be. That means inflation. But you can also know that doesn't mean the Federal Reserve is going to raise rates, because they have to have debasement. The whole system requires inflation. They're just playing a game with you over whether or not it's 2% or 2.5% or 1.5%.
Yeah.
So, but multiple things can be true, and that's why, if you're taking in all of this data and you're observing the financial markets, you have to have somebody that you can communicate with, that you can talk with, to help build a good structural understanding of what your portfolio should be doing, so that at the end of the day, over a long period of time, that number goes up, so you can have a better quality of life and have something for the sacrifice that you've made over the last 30 years in saving in that 401k, so you can have something to show for it. So I don't know. It's easy to for me to roll my eyes and say they're not going to raise rates, right? But at the end of the day, none of it matters, because a decade from now, if you're not invested properly, that $1 million that you have saved in your 401k is going to be worth $700,000 or $800,000. Point blank. Period. Full stop. If you don't do the right things, the stuff in the interim we can argue about and go back and forth over the right policy response. But the truth of the matter is, you must be focused on what can you do with the greatest degree of confidence to have more money 10 years from now than you have today.
And the other factor that we haven't really talked about much, but it probably should at least be brought up, is that the federal government's interest expense is now its largest line item in the budget. And what happens when you have a rate hike to that?
Yeah.
You can't do it.
No,
I mean,
you
can't do it. You cannot do it.
So, but then how can you simultaneously say that? And my response be, yeah, but inflation is actually, CPI is going to go down. Because what you're, and this is the complexity that people miss. When you acknowledge that the central bank and the federal government are going to lower rates because the interest expense is going to destroy this country if they don't. So that necessarily means there's going to be an increase in the money supply. You're going to debase the currency. But how can that be true, but also CPI not surprised to the upside, meaning that you should not invest based on the reaction function of a Federal Reserve expecting runaway inflation? It's because if you have an outsized increase in productivity, especially technology-related productivity, you can live in a world to where you have currency debasement going up while prices in nominal terms, not inflation adjusted even, in nominal terms actually go down for a period of time. So you can end up in this world where, because of productivity and technological advancement, debasement, increase in money supply goes up, prices for goods and services goes down, and you end up with this beautiful gap that allows us to have a period of alchemy to an extent. But the ones that win the most in that situation are risk asset investors, risk asset holders, because, while this glass may be cheaper to make because a robot's making it, this building, things of fixed supply are going to become worth a lot more money in those types of environments, just like happened in the 90s. Very
well, I think that's kind of the position that Warsh has taken. And it's interesting to see in real time, once again, that Warsh is of this opinion that the markets need to read the data for themselves instead of taking it through an interpretation that's given by the Federal Reserve. And so we just saw that happen. The data did what the data is supposed to do. We had this information come in, and we're already kind of digesting this information and coming up with this a week ago 50% or more chance of a rate hike, and now it's sub 30. The markets are saying now it's sub 30. So it is what it is. It's working already. I mean, he's saying that you need to read the tea leaves for yourselves, and people are doing that. And so that's sort of interesting. I'd be interested to see what he says if he's going to do another presser in September, I guess would be the next time he does that.
I think so. Jackson Hole. Why are you going? Have you gotten your tickets? Have they invited you?
I think they don't have any more openings, I think is what they told me.
I took the last one. I will be there. Jackson Hole, Wyoming. I'll have one of the first questions to ask.
Try to take a camera with you so you can get it on the podcast.
No, they will not. They would not let us there. One of the, as we transition to, September, that is going to be very interesting to watch. I think we're going to see a narrative shift, and it's not all, props and high fives to Kevin Warsh. I know also what they're doing with their task force, and they're going to change the way that inflation is calculated, which is another way that you're not going to have headline inflation surprising. This is going to happen. It's happened before. Now, why would it happen? There are good, logical, well-meaning opinions about why the CPI formulation should be weighted differently and changed. But at the end of the day, doesn't really matter. You're going to get a level of debasement that is necessary for the functioning of our society. And that's going to happen. After September, those task force, I believe, will start to present the new framework upon which they view and how they view things. Very interesting, very interesting. Yeah. But let's talk about the AI trade. A little update.
Yeah, we'll hit on this quickly, and then we'll get into the meat of the show in the planning room.
I tried to get to the Google data center that's near-ish to here, but it was
wouldn't let you on.
Locked it down. Yeah, I was going to take some pictures.
Well, one of the questions that's kind of been hanging over the AI trade pretty much all year, I guess you could say, is whether the demand for computing is as real as the spending would suggest. And this week we had a company called CoreWeave, which we've not talked about on this show, but they kind of gave us a good answer to that in their reporting. They had a quarterly reporting. So they're basically an AI infrastructure company. What was their reporting? Could you tell us about that?
Yeah, it was a quarterly revenue of like $2.6 billion plus or minus. It was definitely a record for them. Their backlog was even more impressive. It's like $104 billion backlog.
Yeah, that's a $104 billion backlog for a company leasing computing capacity. So that's not speculation about where prices are going to go or about future demand. It's signed contracts for works that they have to do. That's what a backlog is. And so that's wild.
Yeah, it's like, is AI spending creating real demand? Or is it just hype? That's the question that people keep asking. And I'll digress. I'll save my story for a minute. If there's time, I'll go down the rabbit trail. But it wasn't just CoreWeave. So you have other companies reporting similarly strong results this week. The pattern is definitely consistent. These companies are building the physical layer of the AI economy, the chips, the data centers, the power infrastructure, seeing demand that is running ahead of their ability to supply it with these backlogs. It is definitely a healthy supply-demand setup from the sellers, right? From the suppliers' perspective.
Yeah, the cost question is still there, whether the spending will produce the required return to justify, the amount of spending. But at least the demand side of that question, do people want it? Do people need it? That's being answered in real time. And, companies do want computing power. They're willing to sign these long-term contracts for it, and providers can't build it out fast enough. This is the story of SpaceX, essentially. This is the story of, a bunch of other data companies. SpaceX is going to, explore some way to put data centers in space, essentially, is what their plan is. And so they're constantly signing these contracts. Other companies are signing contracts. These are multi-billion-dollar contracts for this compute power. So it's definitely in demand, yet to be determined if the cost will, if the return is worth the cost. So that's something to keep an eye on. But yeah, interesting kind of context.
Yeah, it is. I was going to try to pull in some data here that I find interesting as part of people's criticism of
the data centers.
Yeah, of the spending, and I just wanted to make sure that I got some of the the data corrector. I almost got it here. Hold on one second. Play some
It's
music or
riveting.
something. Play some.
I'll play some Jeopardy music over it.
Yeah, I'm almost done.
Yeah, I mean it's really hit or miss. You keep seeing different companies respond differently with their earnings. You have, Meta's the perfect example of that, where they had, a lot of spending, not really earnings that the market was expecting to see. And so it's going to follow company by company now. I don't think it's not this idea of everything across the board related to AI is going to rise together. The market is seemingly getting more specific about what companies they're willing to reward for it. So you got Meta actually down almost 10% year to date. And then you got, what was the other company that was, that we talked about with Meta last week? You remember that? I have to go back in the notes and check.
I don't know. But the interesting thing is that you have the build out phase of what's happening with artificial intelligence, where there's this enormous demand for physical raw materials to actually build these giant facilities, and they are huge facilities. That is creating significant backlogs for John Deere, for Caterpillar, for these construction companies, for the steel manufacturers, now for fiber optic, for copper, for the physical server racks themselves, for the GPUs, for the chips, for the light bulbs, for the air conditioning, going on and on and on, for the concrete, for the rebar, for the golf carts, for people to drive inside the facility. It's just limitless, right? And it just keeps scaling on on a log scale. It's not linear. It's just like, oh my God, demand's now tripled. Now it's 10x. Now it's 20x. And then you have these people like Ed Zitron that gets on CNBC, and he just, with a British accent, points out that, Microsoft's, all of, 70% of their revenue are coming from one customer, OpenAI. And then NVIDIA is doing financing for their GPUs from X, Y, and Z. And then that ends up being 40% of this company. And he's just like pointing out that these big numbers are all coming from one or two of these LLMs. And it's like,
Well, I think they see that though. If you're an executive at one of these companies, Microsoft is a good example, and you see this come in your reporting, you're doing your own kind of due diligence before you present your reporting. So you see that, and that's why they're, entering the cloud space and all that kind of stuff. They want to diversify beyond that. Nobody that runs a business wants.
Yeah, but I don't know if that's necessarily true, and that's why I made the cute comment in reference to he gets on the CNBC with the British accent or whatever, and maybe I don't know if he's British or not, but it sounds that way to me. And so, the way we are as Americans is when we hear the posh accent, we automatically assign a higher level of value and weight to what they're saying, necessarily just the way we've been trained by Hollywood, I suppose. But just the simple acknowledgement that these groundbreaking companies are producing enormous demand, but then saying that it's all a shell game or all a scam because they're spending a lot of money with Microsoft. It's like, yeah, but where's the same complaint being raised against Lockheed Martin or Booz Allen?
Well, defense
or Northrop
contractors,
Grumman, with like 98% of their revenue is from one source, and he's not doing backflips, crapping all over the earnings calls of these defense contractors.
Well, you also have to see what kind of, personal portfolios these people have, because that's a lot of the time is what's dictating the conversation. But for example, Amazon was the other company. So you look at Meta, who's down 10% year to date, Amazon, who's up almost 15% year to date. So it's a wide difference here, and it all has to do with the investors are seeing the fruits of the labor on the AI trade, and they're making money from other parts of their business that that's what investors want to see, versus just when every company like that, we talked about the Mag 7 a few years ago, all of them kind of rose in lockstep. It didn't matter kind of what the individual reporting of the companies were. It was like a rising tide lifts all boats. But now we're starting to see that shift and change, and we're rewarding companies who the market feels needs to be rewarded, and punishing companies, I guess you would say, for lack of a better term, that deserve to be punished, I guess. Not that Meta is not going to find a way to turn that around, but that's sort of the conversation that you have to have if you're running one of these companies. If you're Meta and you're looking at Amazon and you're looking at, Microsoft, for example, I mean, what are you going to do? Yeah. Like, you're seeing what you're doing and you're seeing what they're doing. Something's got to change with them. So I don't know. It's an interesting conversation. It's changing every time, I feel like almost every week, but
I don't know. It's just the greater that, I think the sign to look for that true productivity is increasing. There's nobody behind you. You looked over your shoulder. You are safe. You're in a safe place. You're in a safe space. I think just it's the canary in the coal mine to know, are these productivity gains real? Are we seeing true economic transformation as a result of this technology? Is when you start seeing all these people coming out of the woodworks and saying it's a bubble. Because if it was a bubble, they'd be shorting the stocks and they'd be proving us right by the stocks
collapse. There's a lot of people that are shorting the stocks. I think Michael Berry is. Isn't he shorting them? Hasn't he been shorting the S&P all year?
Yeah, well, the last time he was right was the first time he was right.
That tends to be how it happens.
I mean, there you go.
We can name a lot of those people. Let's pivot though, so that we can get into this. We're running up on time here. But talk about small business. This is going to kind of pivot us into the planning room, but we'll talk about how the small business confidence is ostensibly rising, at least according to the metrics. Yeah, and it's interesting. The small business optimism index came in at 99.8 in July, which is the highest reading since August of last year and above its long-term average. We are seeing a break in the trend to the upside. To me, that's been something that's really been lagging. Very similar to the ISM, right? The manufacturing index finally broke up in expansion territory, and we have been for years in a recessionary range. So to finally see that break is good, and to see this break is good. I wish it would have happened earlier. I thought that it would have. So, it's just I want to provide the context there before you go in a little deeper, that the NFIB Small Business Optimism Index coming in at what it did is an expansionary indicator. Yeah, and if you look at small businesses, these are not a niche part of the American economy. They account for like half of the private sector employment in the country. It's huge. So when we say small businesses are struggling, we're talking about almost half the working population. When we say small business confidence, like you just said, is rising, we're saying something real about the economic conditions facing a very large percent of the American workforce and American owners, company owners. Yeah, I mean, the inflationary period and post-COVID definitely made things for the input side more expensive. Then the reaction function of the Fed made interest rates go up, which made borrowing more expensive. And it was a painful experience for small businesses. Those headwinds haven't disappeared, but the direction, the rate of change is materially better for the small business environment. And with that set up, let's walk into the planning room, because I think we're going to talk about small businesses. Yeah, we are going to spend a little bit of time here on small businesses, what the data means, why they matter, so forth and so on. When we talk about small businesses, we're not just saying it as financial advisors who work with small businesses. We do that, but we're saying it as a small business owner ourselves. Momentum Wealth is a small business. This podcast is a production of a small business. We know what it's like to make payroll. We know what it's like to worry about interest rates because they affect your clients or your borrowing costs. And we know what it's like to build something sustainable while also having to build something that takes care of people that work for you. We understand that. We live that day in and day out. So we have kind of a unique relationship with the small business community and our small business clients as well, because we understand that in a way that not every advisor does, essentially. Yeah, and so when you see those indexes come in like that, and you look at those that are kind of on the ground floor of the economy, whereas your large corporations are going to have your analysts, you're going to have your economists, you're going to have sophisticated forecasting tools. Small business owners are reading like their cash registers, their invoices, customer traffic. In metrics they touch and feel on, and they can see the change right there. It's real-time economic data, and to see that number jump and do what it did, it kind of gives you
the thinking that maybe the weak job numbers may be very short-lived.
Yeah, well, let's talk about what the data actually means. So the NFIB is the National Federation of Independent Businesses, and they survey small business owners every month across a giant range of questions. So they would ask things like, are you planning to hire, or do you expect more sales this month? Is now a good time to expand? You think economic conditions are going to get better or they're going to get worse? And when the index is above its long-term average, as it is right now, you mentioned 99.8, generally signals that small businesses feel stable enough to invest. They want to hire, they want to take on risk. And when it's below average for an extended period, it signals that owners are pulling back, which tends to flow through to those decisions about hiring or spending, or those kind of economic stimulating activities that you would want to see from a small business community. So it's very important to look at this and see that this is what we would see as sort of a leading indicator, really, when you have this sort of amount of confidence within that small business sector.
Oh, yeah. And right here, absolutely, the specific number that jumped most in July was hiring plans. So, yeah, it's something to pay attention to for sure. It is forward-looking, hasn't happened yet. And it's not business owners saying, hey, things are the best they've ever been. They are not saying that. But they are saying they expect things to be good enough or to improve to the point where they may actually pull the trigger on hiring people they may have been wanting to hire and haven't yet done it.
Yeah.
So historically, that's been a leading indicator of good things. And now when we look at what small businesses are, just some context, it's generally a firm less than 500 employees. Okay, so that captures a big range. There's a big difference in a company with 2 employees and a company with 200. That's a big difference. But 500 employees or less, and that can be an accountant, it can be a contractor, it can be a landscaper, or it could be a manufacturing shop. So when you think about the small business, you really look out in your community and you think about companies that are not publicly traded. 90% chance that's a small business.
Yeah,
good way to look at it.
Yeah, a lot of that going on. It's like half the private sector employment in the country. And it's not just that they employ people. It's not just that they, are active in their community. They're woven into the fabric of these communities in a lot of ways that large companies really can't, because they try to. But when a local business does well, it'll hire locally. It'll buy from local sponsors. It'll, provide sponsorship opportunities for local sports teams, and the owner lives down the street and all this kind of stuff. The economic multiplier of a healthy small business is real, and it has a tendency to compound within the community that it's involved in. So that's, small businesses you have a whole week dedicated to small businesses. Small Business Week, you'll see the signs going up all over downtown when it's Small Business Week, but it's, it's something tangible that you really see. People have a tendency to want to, if they can, shop local or buy local or support local businesses. You'll see sometimes when local businesses are struggling, you'll see Facebook posts on these groups about, hey, this restaurant is really struggling. Let's go support them. This is the idea behind this community-based sort of business, is that you're helping literally the people that live down the street from you.
Yeah, no, it's definitely, I think it's important. And I think there's a healthy balance in the interactions that I choose and the businesses that I choose to do business with, on a mixture of local, of small, or relatable. It doesn't even have to be local to me. It could be a small business out of Montgomery or out of Jackson, Mississippi, or out of Monroe, Louisiana. It doesn't have to be, right down the street for me necessarily, but that relationship where there's accountability to somebody that has skin in the game, and then balance that between maybe your national providers of things, right? There is a healthy balance to strike. And I think most people, when they really are given the choice, like to stay small, like to stay with people that are accountable to that customer. And small can mean all different types of things. We've, in this business, by some we're considered large, and by others we're considered very small, right? It's all relative based on what you're looking for and what your needs are. But let's talk a little practically here, because I think we could kind of roll this into something that's more than just the righteous commentary on the importance of small businesses and the appreciation of those that risk capital and take periods of time where they're not going to make any money to start something and to grow the economy that way and to be the engine of the American economy, because we respect that and we appreciate that and want them to succeed. But let's talk too about like practically whether you currently have a small business that you're just started, maybe you're thinking about starting one, maybe you work for one, and kind of touch briefly on the structural setup and some things that people need to think about, you know, if you're just starting or maybe have thought about in retirement starting, you know, a business. And I guess the first would be just thinking back on our journey. What's the entity? You hear these people talk about things. What does that mean? Yeah. What is that? How do you actually, quote unquote, create the business?
Yeah, you think about things like sole proprietorship. You know, somebody may have a DBA, an LLC, an S Corp, a C Corp. All these structures, they generally affect how you're taxed, you know, how you're protected personally in the event that you have a lawsuit that your business faces, how you bring in investors or partners, how you pay yourself. You know, it's not really a decision you can make with a Google search. It's going to take a little bit more than that. It's a conversation for, you know, depending on your business, maybe an attorney you bring in, maybe a CPA can help you with that if you've got a great CPA. It's worth having the conversation about structure early because it can tend to change how you operate over the years. And it's not necessarily something you can't get out of. You can pivot your structure. If you start out as one, you can pivot to the next, but it's worth knowing kind of what the ins and outs are of the business. If you start out as an LLC, what does it mean for you to take on dollars into your business at a later point? Can you do that? Do you need an entity kind of structure shift? We've talked to a lot of business owners like that who figure that out years down the road. Like, oh, you know, I want to be able to take these investments, you know, these investment dollars in, but I can't do it with this structure. So I've got to make those change.
Yeah. So you look at your structure and I think Google searching is okay, but I think it is definitely worth a conversation with your CPA or with an attorney. And it could even be an online attorney. If you can't find one locally to have a conversation with you, it can be online and explain what you're wanting to do and then get that feedback.
It's really a good metric, though, for a CPA, if you are a business owner, to have a discussion with a CPA that revolves around businesses. Because if your CPA is not comfortable around that topic, maybe they're more comfortable with the personal tax returns, maybe they don't have a lot of answers when it comes to business, then already at step one, you have a decision to make.
You got to find a new CPA.
You have to find somebody who's going to be able to help you through the growth cycle of your business and the changes that you might face. So it's a really good kind of litmus test, I think.
And through those conversations too, your CPA can help guide separation, right? You decide to open a small business and you choose that entity. You definitely want to keep your personal and your business finances, separate. You don't want to commingle. We spoke about that in the podcast we did with one of the CPAs last year, that, really stress the importance of that. And then something that we touch a lot on, that is a part of what we do, full disclosure, is once you're making some money with your small business and once you're seeing, some reward for that risk, is how do you use that business entity to save some more tax dollars and get some growth for retirement accounts? And I'm not going to spend too much time, but whether it be a SEP IRA or a solo 401k, you can contribute sometimes up to $70,000 in a year, sometimes even more. With some different 401k setups that we have done in the past, it can be significant. It can be much, much more than what you think. And so it's a great thing. A lot of people forget because you're like, okay, hey, I had this idea. I'm doing this landscaping company. I've scaled. I've got 10 employees. You're doing great. You're making good income. But now it's like, okay, we need to start like diverting some of that. And you can get the same tax savings that you would get by buying a new truck. But you don't need the new truck, right?
Well, that's a good example actually with the landscaping company, because companies like that where you may have an influx of seasonal workers or your workforce may not be there for very long and you feel like you're kind of handcuffed in what you can do with retirement planning, there are caveats for that. So it's not necessarily like a malicious thing that you just don't want to invest in your employees' welfare or their benefits, but you can do that as a business owner and have sort of a different mechanism there for employees who, stay longer versus ones who maybe you're just temporary or short term, where you can contribute to your own retirement accounts. You can contribute to people who, are on with you maybe all year, whether it's a landscaper or any number of professions there. But there are possibilities. So that's one of the big things that your CPA at the end of the year says, hey, you really need to spend some money. You got to buy another truck. And they're like, I don't need another truck. I got a fleet of trucks. I don't need that. So that is an option, and you just have to build the plan out correctly. You have to, sit down with somebody who knows how to build these plans out and make the most of it for you.
Yeah, I think so as well, and just really underscore the importance of asking questions. If you're thinking about a side hustle right now, or you're thinking about full-time job replacement, or you're thinking about maybe a part-time gig that you're going to do in retirement, or as you prepare for retirement, ask questions, reach out to people, reach out to us, go to momentumwealth.us. We'll be more than happy to answer some of your questions, give you some advice, give you some things to think about, also can help connect you with CPAs that you can trust and help connect you with lawyers that you can talk to, that we have had good experiences with and have had great interactions and have built a level of trust. We'd be more than happy to have those discussions with you. But as we wrap the planning room, just know that if you are a small business owner, and you feel that the economy is picking up, and you're kind of just waiting on maybe it be interest rates to go down, or just that right employee or that right applicant to walk in and fill the position that you've been needed to be filled, it doesn't seem like you're alone. It seems like everybody's kind of thinking and feeling the same thing. And to be honest, we have as well. We've had some internal discussions on some expansion, and it's just interesting to see how, those feelings and conversations we've been having with other people as well is now materializing into a national statistic that's like, oh, it's interesting.
Yeah, if you're a small business owner and you're watching this on YouTube or on Facebook or wherever you're watching this, drop a comment, just like drop a thumbs up emoji or something. If you're seeing what this data is showing in real time, if you're seeing orders pick up, if you're seeing potential expansion down the line, if you're preparing to hire some people, just let us know.
Yeah, absolutely. And best of luck to you as well as you do that. So as we wrap third straight week of gains, September rate hike looking unlikely. You heard it here first from me and Garrett. AI demand through the roof. Really don't have much else to say. I think next week we will not talk about oil, and we may still talk about AI. I predict.
I think we'll talk about oil and AI.
Oh my God.
Yeah, I don't know. Seems to be they're coming hand in hand. But that's been good returns for the week. Thanks for spending some time with us. We hope that you've gleaned some information from this. If you have found it valuable, feel free to share, like, comment. It helps us out. Definitely.
Even if you don't like it, comment that you don't like it. All the comments help. Nothing but love. Even your hate is love around here. It boosts the algorithms.
Does it?
I think so.
Any small business owner that may have listened to this that has questions, reach out. I'm happy to have a conversation with you. But until then, see you next week. Have a great week, great weekend. I guess the week is over, so have a great weekend, and we'll see you back here next week.
Take care.
Goodbye.